Peter Lynch, one of the great investors of our time, famously said, you need to know that the market's going to go down sometimes. If you're not ready for that, then you should not own stocks in the first place. So hi everybody, welcome to my channel. My name is Zalman Cole. I appreciate you watching. Today we're going to talk about 4 ways to protect yourself against a bear market. So since the 1950s, there have been roughly 11 market pullbacks, or bear markets as they're referred to. Again, when stock prices are through the roof, companies are overvalued, people are dumping their money everywhere and anywhere, people tend to forget about the inevitability that comes after the bull market, which is the bear market. It could come at any time. So I don't mean to be a downer. I'm happy that a lot of people obviously are making a lot of money. Young investors are making a lot of money. I think it should be mentioned, and we should talk about the fact that it's also sad that many people are hurting because of the pandemic, because of the lockdowns. A lot of people are losing their life's work, their businesses. So I guess 2 things can be true. Sad for those suffering and happy for those making a killing. In any event, the euphoria of the stock market boom can be a dangerous drug, especially in the stock market. I think this sentiment is very relevant today, and that's why I want to talk about it. So nearly every day we receive notifications that a particular stock or the market in general has hit all-time highs. So that seems amazing, but it also has to be talked about that it could be a problem. So in this video, I just want to talk about the inevitability of the bear market, discuss 4 ways that investors can protect themselves from the very painful fallout of a market pullback, a bear market. So again, I'm not trying to predict when the crash might come. I don't have to tell you that a bull market could last for many years at a time. So we could be seeing these highs happen many, many times over again for the next couple of years, but it's still inevitable. So let's just quickly answer a couple questions before we go into those 4 things. So what is a bear market? A bear market is classified as a market drop of 20% or more off its highs. So in a bear market, there's a general environment in which investors are more risk averse as opposed to risk seeking. Basically no fun anymore. People aren't speculating on anything. No one's putting their money anywhere and everywhere. But then there's the question of what causes a bear market. And I just want to answer that briefly because I think it's important for investors to know, even though it's very difficult to predict. So Philip Carrot, a uniquely successful American investor, famously said this: it is usually much simpler to forecast a bull market than to call the turn at its end. There are many different causes for a bear market. That's why it's so difficult to predict when it occurs. It's also sometimes random. So again, good for investors to protect themselves from it happening at any point, any time. So let's give a few examples. So sometimes a bear market is set off by some kind of external shock, like let's say a significant piece of political or financial news. So think about 1990, the Gulf War. Saddam Hussein invades Kuwait for its oil reserves. So that triggers a major market sell-off, leads to a bear market. Stocks were being sold before that, but it really precipitated the matter. So another cause could be, and this is often the case, rampant speculation. So for an example of that, let's think about the dot-com bubble in 2000. Stock valuations were higher than at any time in the Dow's history. And that was specifically driven by unchecked speculation, divorced from any due diligence or sensible future growth potential for many of these companies. If it had .com at the end of it and there was some hope, people just put their money in and also lost. Big. So a bear market can also be triggered by the failures of the banks, who are essentially providing people with mortgages on the go. Sounds familiar? That obviously happened in 2008 when we had a housing bubble crash that tanked the market completely. People lost everything. People are still recovering from that, unfortunately. Then there's some really unique ones. In 2011, for example, some experts believe that the bear market in April could have been triggered by the release of Michael Lewis's book about a European debt crisis. So people weren't aware of that issue. All of a sudden it comes to the fore. People start panicking. They sell their stock. Boom. That's it. That's how random and quick. Sometimes there's no articulable reason for the market crash. And that, like in 1961, when there was a flash crash, stocks in one day fell 6%. No one really has had a good explanation for that, and no one really has a good explanation even today. Economists don't have a unified understanding of why that happened. Yeah. So how do we prepare ourselves? So number 1, keep cash. The famous saying, cash is king. certainly applicable here. So Warren Buffett, the Oracle of Omaha and successful investor, he's always maintained that every successful investment portfolio should hold a good amount of cash. Many suggest between 20 to 30%. Goldman Sachs reformed their opinion in 2016 and recommended that investors increase their cash position. For example, for those with 10% cash, they should raise their position, they said, to 15 to 20% cash. So let's talk about that. So there are four primary reasons why cash is so important in an investment, a successful investment portfolio. So first of all, it allows for opportunistic purchases when a company's valuation drops to attractive levels, or at least to levels that are based in actual fundamentals of the company rather than in more speculative territory. So let's break this down. You like a company is very good, but it's way overvalued. The stock price is very high. You can't afford it. What do you wait for? You wait for a market drop. It drops, now you have cash, now you could buy it at a discount, and then inevitably it goes up and you make all that money. Another reason why cash is so important is because it allows for dollar cost averaging. So dollar cost averaging, for those of you who are unaware, is the method by which you bring the average of your stock position lower by consistently buying when the price of the stock drops. So it's a very valuable investment strategy. Basically, you buy, but then when your stock price drops, and that inevitably happens, even a couple dollars, you can buy more, and then you're bringing your average down, and you have cash, then you can do that. Without cash, you're screwed. So the third reason why cash is so important is that it curbs losses when the market drops. So think about a market drop of 20% in a fully invested portfolio, 100% of your money invested, you lose 20% of that money. You lose a lot less if you have only 80% invested. So obviously that's good, and think about the fact that now you also have 20% to buy more stock when it drops, and then the inevitability of the bull market will come. You'll make a lot more money. So the final reason why keeping cash is is that it gives investors peace of mind. The ability to sleep well at night is obviously important. This can also reduce panic selling when the market drops, because you know that you have the money to purchase more stock and you don't have to sell at a loss to get in lower, which raises all other kinds of issues. Think about that cycle. You know, the market's dropping, you know it's going to drop more, you hear the news, now you have to pull out, so you're selling at a loss, and then you're going to be putting back in. But let's say the market drops even further, then it's just not good. So have cash. The second thing that you can do to prepare for a bear market is not to speculate too much. So by this I mean that most of your portfolio should be targeted at putting your money in the best companies. Companies that are producing the best products, by extension, have the best balance sheets. So alternatively, you can invest in the market as a whole. If you don't have time to find the best companies, you don't have time to do the research. So that means you can invest in indices that track the S&P or the NASDAQ, or you can invest in an ETF that invests in many successful companies, and that way you have exposure to them. So in contrast, there are the spec plays. This is what you want to be careful with. So these are the companies that present high risk, specifically because they can just be an idea or a pipe dream, maybe still in developmental stage. In other words, an investor can probably articulate what the company seeks to do, but you can't point to revenue or cash or maybe even a product yet. So the reason why spec plays are so attractive for investors, obviously, is that you can buy shares for very cheap, and if the investor is right and the company becomes mainstream, they stand to make a lot of money, obviously, because of how early they got in and how much of a discount they paid for their stock price. So think about Home Depot in the 80s. It was considered a speculation play, and then it became mainstream, and now people had a very nice return. Think about Tesla now, even. About to be added to the S&P 500, big milestone, congratulations. People invested in the company when it was one day away from bankruptcy, as Elon said, are now laughing on their way to the bank because of how much money they made. But that was pure speculation at one point. It was just an idea. So obviously there is some room for speculation play in your portfolio. The point is to find a company that you really see being able to take over some market share to defend itself against competition in the future. So depending on how much money you have, you want to just allocate, though, a small percentage for a speculation play. Alternatively, you could also put your money in ETFs that include many speculation plays. Think about putting your money in an ETF that includes all the new electric vehicle companies instead of putting it in just a NIO. One of them is successful, you're going to be successful. Here's the thing, though, with spec plays. Cut your losses. Don't put too much money in. take profits. You know, when people catch on and all of a sudden it goes 90%. Think about Nikola Motors. You know, you want to be able to sell. The other thing is to have the mindset that you could lose all of this money. Think about the dot-com bubble. You know, everything was a speculation play. Most people lost all their money. Most speculation plays end up going to zero. Another way to protect yourself, and this is the third way against a bear market and the inevitability and the randomness of one, is to diversify your portfolio. So this includes an investment into real estate. Real estate markets do often move with the stock market cycle, but there are benefits to owning real estate as a diversification technique. So think real estate, for example, can provide you with passive income, tax benefits, different tax benefits, hedge against inflation, and the ability to leverage, take out a loan. So you might not make as much, yes, in real estate as you would in the stock market, but being able to point to a property and say, that's mine, I get passive income, that's seen to many as a safer bet. So you can also diversify into precious metals if you want, like gold. You know, research suggests that in the last 10 years, gold has shown little to no correlation with blue chip or small cap stocks, so making it an exceptional diversification for investors who might fear stocks have risen too much, too fast, and are due for a pullback. So it's a hedge against inflation too. It can be stored away, and it keeps its value for a very, very, very long time. So obviously an important commodity, something to look to for investors who are trying to diversify. So another thing, and the fourth thing, is to take profits. So William O'Neill, founder of Investors Business Daily and successful money manager, said about investing in stocks, the secret is to hop off the elevator on one of the floors on the way up and not ride it back down. So when is a good time to take profits, the question is. So let's say a stock rises dramatically. This can be led by speculation and it can be dangerous. So nothing is wrong with selling. You can also buy back, by the way, by dollar cost averaging in the future if you feel that you sold too soon. So another way is, another time to take profit or to think about it is if a company's valuation is significantly higher than that of its peers and starts to lose any basis in reality or in future potential growth opportunity. So then you might want to sell. You may also want to sell when the PE ratio, per earnings share, of a company exceeds its average PE ratio over the last 5 to 10 years. That means that it's starting to lose basis in the fundamentals of the company, the balance sheet. That's a problem. Another good time to think about selling is if a company's revenue begins to decline. That usually is a sign of reduced demand. So obviously, you want to wait and see what the company says in their quarter earnings report, whether there was a good explanation for the decline. If there is, then you might not want to think about selling. Some experts believe more rigidly that investors should think about taking profits when they reach gains of between 20 to 25%, just a number. That's based on the fact that stocks, in their opinion, tend to advance, that much before the market corrects. So in this scenario, by the way, you can always just take out a 20 to 25% and you can buy back. And there's that opportunity that now you can buy at a discount if you feel that, let's say it has the ability to move to 40, 45%. So I just want to leave you guys with a very relevant quote from Philip Carrot, again, very influential investor. So he said, bull markets and bear markets last long enough just so that the average trader is likely to forget by the time the climax is approaching that any sort of movement is possible. So that is obviously very relevant. So just be aware, be careful. Everybody's excited. People are putting their money in. It could last for years. People can make a lot of money. It's a very good time to invest, obviously. Interest rates are low. It's not worth investing in a savings account. But just be aware and use these 4 tips that I hope will be useful and I hope I've explained properly, just to ensure that you're diversified, ensure that you have cash, ensure that when the bear market comes after the euphoria of the bull market, which again is inevitable and random, it could happen tomorrow, that you're ready. That you can, it's like a soldier in the army. When shit hits the fan, they're ready. They're ready to go. So be that soldier. Be ready to go. Use these 4 tips. Thank you so much for watching. I really appreciate it. Please like, please subscribe, please comment below. Let me know if there's anything that I can talk about that you'd be interested in. Please, I'd like to have a discussion with you guys and girls. And we'll see you next time. Thank you.